everyone, welcome to the very first lecture of Conceptual Academy. This academy is actually designed for student who wants to save time and understand finance and accounting concepts without getting stuck in difficult bookish language. So here I will break down even the most complex topics into simple, clear and practical explanations. And to start our journey, I have chosen a topic that many students often find tricky, that is bank reconciliation. By the end of this lecture, you will see how easy it actually is. So let's begin and explore what is bank reconciliation and what are the changes that affect bank reconciliation statement. Many times the balance in the cash book of a company does not match with the balance shown in the bank statement. So a bank reconciliation is a process that explains difference between the balance in your company's cash book and the balance in your bank statement. It not only helps in detecting errors but also certain omissions or frauds and ensures that financial records are reliable. Remember that bank reconciliation is not something we do once in a while. It has to be done periodically, and most businesses prepare reconciliation at the end of every month when the bank sends a statement. Some businesses with a lot of transactions even do it weekly or daily. The purpose is same, that is to catch mistakes or missing entries or fraud on time. So you can say that reconciliation is like a regular health checkup for the cash records of a business. Now let's understand why differences occur between our cash book and the bank statement. The first reason is timing differences. These happen because transactions don't always appear in both records at the same time. For example, if we issue a check today, we record it immediately in our cash book, but the bank will only show it when the other person presents it for the payment. Similarly, if we deposit money into the bank, it may take a day or two to clear and appear in the bank statement. The second reason is unrecorded transactions. Sometimes the bank records a transaction but we haven't updated it in our books. For instance, bank charges, direct customer deposits or automatic payments like utility bills are directly deducted by the bank. Unless we enter them into our cash books, these will be different from the bank statement. The third one is errors. Mistakes can be made either in our cash book or in the bank statement. Maybe we recorded the wrong amount, forgot to write any entry, or the bank mistakenly posted something incorrectly. So these errors also cause mismatches. So in short, timing issues, unrecorded transactions and error are the main reasons why our balances doesn't match with the bank's balance. Let's understand these differences with real life examples. Timing differences. You issue a check of $10,000 today. What happens? You will record it in your cash book immediately, but the bank will only show it when the person actually presents it for the payment. Similarly, if you deposit $25,000 in a bank, it may take a day or two before it appears in the bank statement. The second one is unrecorded transaction. Sometimes the bank processes a transaction but we forgot to enter it in our books. For example, the bank deducts $500 as a service charges, but unless we record it in our cash book, the balance will differ. Or a customer directly deposits $15,000 into our bank account. It shows in the bank statement, but we won't see it in our cash book until we add it. The last one is errors. Mistakes can be made either in our books or by the bank. For example, we might accidentally record a payment of $8,200 instead of $8,020 in our cash book, or the bank might wrongly debit $1,000 to our account. Both types of error will create a mismatch between these two statements. Now let's understand how we prepare a bank reconciliation. There are certain steps involved in it. Step 1 is to collect the records. First we collect the two main documents, the cash book, which is our company's record, and the bank statement, which is the bank's record for the same period. Next we compare entries. We compare the deposits and withdrawals in the both records. Any items that appear in both can be ticked or checked off. Step 3 is about identifying differences. We look for mismatches, and these usually come from timing differences, unrecorded transactions, or errors, as I told you before. Step 4 is about adjusting the cash book. After that, we adjust the cash book for items we missed, such as bank charges, direct deposits, interest credited, or standing orders. Step 5 is to prepare reconciliation statement. We can start either from the cash book balance or from the bank statement balance and adjust step by step. The last step is match adjusted balances. Finally, we arrive at the adjusted balance. At this point, the cash book and the bank statement should show the same figure, and that means our reconciliation is complete. So the steps are collect, compare, identify, adjust, prepare, and match. Let's see a simple example to understand it better. Suppose our cash book shows $10,000 but the bank statement shows $9,500. So there is a difference of $500 in both these balances. We find that a check of $1,000 is still outstanding and the bank charges of $500 are not yet recorded. And after adjustment, both balances should come to $10,000. So how this reconciliation happened, let's understand it. We will start from the bank statement balance. Bank statement balance is now $9,500. We will add the check issued but not yet presented. So there would be addition of $1,000 because bank has not yet deducted it and it is already in our cash book. Then we will less bank charges not recorded. The bank has deducted it but our cash book hasn't recorded it. So there would be minus $500. So the balance would be $10,000. That is an adjusted balance. In our last example, we started from the bank statement, but now we will take the balances as per cash book. Suppose there is a company, XYZ company, and it has a balance of $10,000 in its cash book. But when we compare it with the bank statement, we see some differences. First, we notice a deposit of $2,000 made into the bank that has not been credited yet. So this will be added in our balance. Next, there are checks issued worth $1,500 that are still outstanding, so we will deduct that. The bank has also charged $500 which we had not yet recorded in the cash book, so we will subtract that as well. Finally, a customer directly deposited $1,000 into our bank account, which we will add. So after making all these adjustments, the balance as per bank statement becomes $11,000, which now matches with our adjusted records. So in other words, after adjustment, both cash book and the bank statement should show $11,000, and this shows that reconciliation is complete. As I told you, when preparing the bank reconciliation, we can start from either the cash book balance or the bank statement balance. Then adjustments are made that differ depending on from where you start. If we start from the cash book, we adjust for items we missed, like bank charges, direct deposits, or interest. Similarly, we start from the bank statement, we adjust for timing differences like outstanding checks or deposits in transit. So here is a table to help you understand what adjustment to make if you start from the cash book or from the bank statement. So in the end, both methods should lead us to the same adjusted balances. Few things are very important to remember about bank reconciliation, because it is not just a routine task and it is an important control tool, and we should know that it helps us to detect fraud and ensure that our reporting is accurate and assists us in proper cash flow management that builds our confidence in accurate accounting system. Now let's have a quick recap with me. Bank reconciliation compares the company's cash book with the bank statement, and the differences arises due to timing gaps and errors. By adjusting these balances, we make sure that our records are accurate and reliable. Now I would like you to must go for the concept check as well, because it will help you understand and recall the concepts you have just learned. Question is, ABC Limited has the following details on 31st August 2025. Balance as per cash book is $15,000 and check issued but not yet presented to the bank is of $3,000, and deposits in transit are $2,500. Bank charges not recorded yet are of $200. So prepare the bank reconciliation statement and find the adjusted balance. Don't forget to share your answer in the comment section and I will pin the correct answer. And that brings us to the end of today's lecture on bank reconciliation and the changes that affect it. We learned why differences occur, the adjustments needed, and the steps to prepare a reconciliation statement. I hope this lecture made the concept clear and saved your time in understanding this topic. If you found this helpful, don't forget to subscribe to Concepture Academy and stay updated with more lessons in finance and accounting. You can also follow us on Instagram and Facebook for quick learning content. And remember, learning is a journey, and together we will keep making complex topics simple. See you in the next lecture.